welcome again, everyone. Thanks for joining us today. This is our April virtual workshop, of course, and today our focus is on two very relevant and timely topics for certain families. It's going to be first-time home buyers. That also is going to apply to anyone buying their next home, the second, the third, the fourth home, and then also the second topic, teenage drivers. So we're going to hit about 10 minutes on each topic. We'll have a brief Q&A at the end to talk in as much depth as anyone would like to dive into. And a reminder up front here that we do record these workshops so that they can be available to clients and guests in the community after the fact for those who are not able to join us live here. So with that said, please bring your questions, your concerns, whatever you'd like to discuss. That is what we are here for. Just keep in mind that it is going to be recorded, and so it may be viewed by others. If there's anything you'd like to talk about privately after the call, of course, please reach out to anyone on our team. That's what we're here for. We're more than happy to talk, and of course, happy to help. Derek, with that, let's get things rolling. Our agenda for today, like I said, part one, what do I need to know when buying my first or my second or my third home? Part two, what should I do with my teenage driver? Now let's jump into part one to kick things off. First-time home buyers, or anyone really that's in the market for that next home. Question, of course, that's on everyone's mind. Number one, how am I going to find a home that I can actually buy? Once I do, what's it going to cost for me to insure that new home? What are the big factors, Derek, that play a role there?
Yeah, well, like you said, it's a timely question because the real estate market has seen a lot of price appreciation over the last few years, and people are wondering, does the increased value of my home impact the cost of the homeowner's insurance? That's not necessarily the case. The three main drivers of the cost of a homeowner's policy are someone's credit score, the size of the house, and who that home is eligible to be insured with, which insurance companies want to offer a policy for it. And we'll touch on some of the things that make a home eligible or ineligible in a few slides.
Interesting. So when I'm looking at that next home, it's interesting that I don't see anything here about market value and some of the other specifics that would be kind of on my radar when I'm looking for that next home. Credit score, that's interesting. When I think of credit score, I think of my mortgage. What do I qualify for? Can I get approved? How does that apply to an insurance policy?
Yeah, well, the credit score from a homeowner's standpoint has a very, very heavy impact on the price of the homeowner's policy. It's actually opposite of a mortgage. Like you said, most people that are applying for a mortgage know that their credit score is really what's going to determine whether or not they qualify for the mortgage. But the lender uses the worst of the two spouses' credit scores, assuming there is a couple that's applying for that mortgage. The homeowner's policy does the exact opposite. It takes the better of the two credit scores and it uses that to dictate the price of that homeowner's policy. So what's surprising to a lot of people is how impactful a credit score is to the price of a homeowner's policy. So what we're showing here is what the typical home in West Michigan, think of your $250,000 to $300,000 home that's in your standard subdivision, what that home would cost to insure based on the highest of the credit scores that would apply to that policy. So what you'll notice here is that down in the lower end of the spectrum, let's say 500 to 700 from a credit score standpoint, the insurance can be a little bit expensive. You'll see that going from 700 up to 800 or 850 cuts the insurance premium in half. So these figures here are based on the exact same home, same coverage amount, same specifications, simply difference in the credit score that's being applied to that policy. So it's very, very important for people to have their financial house in order when they're going to buy a house, because not only do they, of course, want to qualify for that mortgage, but They, of course, want to be able to afford the monthly payments on their homeowners insurance as well.
Interesting. So there's some truth then to the saying today that the insurance company cares more about the person than they do about the property being insured. Is this kind of what that's telling us?
That's exactly right. You'll see at the bottom of this slide here, 50% of a policy's premium is based on the policy owner's credit score. That's not just applicable to homeowners insurance. You'll see that from an auto insurance standpoint as well.
Interesting. Okay, great. Well, that's very helpful, Derek. What about number 2? You have square footage listed here. That's interesting. How does square footage impact the expected cost of a home insurance policy?
Yeah, well, what I've got here is something that we provided to some realtors when they asked, hey, how can we get a rough ballpark of what one of our clients is going to pay from a homeowner standpoint if they actually proceed with the purchase of this home? So Brian and I put together a quick 30-second homeowners insurance calculator. It doesn't have all the factors, obviously, but these are the main factors that are included in there. You'll see the first bolded line is the estimated reconstruction cost of the home. The second bolded line is the home info. The third is the client info. The estimated reconstruction cost of the home is generally going to be the coverage amount on the policy. So the estimated reconstruction cost takes into a lot of things: the square footage, the style of the home, if there's a finished basement, if there's an attached garage, what kind of siding is on the home, et cetera, et cetera. That is really the meat of that insurance policy. Most of the other coverages are derived based on that coverage amount on the home. So the reconstruction cost, building the thing brand new, is going to obviously have a big impact on the price of that homeowner's policy because it's going to determine the coverage needed.
Interesting. Okay, so it's not necessarily the square footage that drives it. It's the fact that the more square footage, the more coverage is needed on the policy in case, God forbid, that home goes all the way down and it needs to be rebuilt. Tell us what this example or what this illustration here is kind of laying out, Derek.
Yeah, sure, absolutely. So you'll see the same house here, just before renovation and after renovation. Same square footage, same style, et cetera, et cetera. Well, the homeowner's policy for this home, whether it's the one on the left that needs a lot of work or the one on the right that's beautiful, the homeowner's policy is going to have the exact same coverage amount because the homeowner's policy is designed to rebuild the home brand new based on today's labor and materials pricing. So let's say that house on the left, its market value is 50 grand because it needs a lot of work. Well, post renovation and all of the updates, it's worth, let's say $450,000. Well, that's great and that's fine. But the person that bought the home for $50,000, because that's what it was worth, their homeowner's policy is going to look identical to that person that bought it at $450,000. So when they're looking at the cost of their insurance versus the value of their property, it feels much more expensive to insure this home on the left that needs a lot of work than the home on the right. You'll see the bottom line beneath each home is the insurance cost per $1,000 of market value. It's much, much more expensive feeling for the home on the left than the home on the right.
Got it. Simply because the home insurance policy is on a replacement cost basis, meaning a brand new construction basis. So if either of those homes goes down in a total house fire, you're going to end up with a home that looks like the white one on the right because it's going to be rebuilt brand new. So the insurance policy is going to respond accordingly. Is that right?
Exactly. And we see this come into play pretty often with homes in some of the older neighborhoods downtown. Might not have a ton of market value, but it's a large home that would take a lot to rebuild it. The insurance policy is going to have a coverage amount equal to the reconstruction cost of the home, even though the market value might be just a small fraction of that.
Got it. Okay, that's helpful. That's helpful. Now, number 3, eligibility here. When I look at that photo of the house, the yellow home on the left, number 1, insurance company even approve insuring that home? And what else do we need to keep in mind when it comes to, can this home that I'm considering actually be insured? And is that insurance going to be reasonable? Tell us about that.
Yeah, well, the insurance industry has changed a lot over the last 50 years. There's so much more information available today than there's ever been in the past. And the insurance companies take that information and they use it to determine what types of homes they want to insure. So you'll see some of the big ones listed on this slide. Number one, plumbing. Homeowners insurance companies know that galvanized plumbing that was used in homes typically before 1960, it has a lifespan of anywhere from 50 to 85 years. Well, guess what? If it hasn't burst yet, it's probably going to burst pretty soon. So a lot of insurance companies are shying away from homes with galvanized plumbing. The image in the middle there is your typical wood burning stove. Some insurance companies have a little bit of an issue with that. Others have no concerns. The pool with the diving board, that can be a big no-no. It can be a total exclusion from coverage, meaning the insurance company does not want that policy at all, or it can be a surcharge. Same thing is true with the dog listed on the bottom left. And obviously you've got knob and tube is usually pretty scary from an insurance company standpoint. The image on the bottom right is someone running a daycare out of their home. So it really depends on the characteristics of the home and what the home is being used for that determine which insurance companies it's eligible to be insured with. The more companies, the more options, typically you're going to have a better rate in that instance.
Got it. That's great. And of course, one reason that we've chosen to be an independent agency is so that we have options with several insurance companies so that we can specifically tailor that based on the home. What's the plumbing like? Is there a wood stove? Is there a pool? Because like you said, some insurance companies, no thank you, not even going to put their hat in the ring, whereas others may not mind. So that's a great note there, Derek, about things to keep in mind when considering how eligible is that home going to be for insurance. Now, a couple of potential red flags here before we move on, but pending sale that fell through, that's pretty unlikely in today's real estate market, but could there have been an appraisal issue? Was there an inspection issue? Remember that every home insurance policy is going to involve a home inspection from the insurance company. Now, it's nothing like the pre-purchase inspection that you did, but they're going to hire an inspection company, pay them $100 or so, and have them come take a few photos of the home. They're looking for things like the condition of the roof. Is there missing siding? Is there an elevated porch that doesn't have any railings on it? The kind of things that they're going to ask be corrected shortly after that purchase goes through. Number two, renovations without a permit. Of course, that can be a bit concerning. And number three, just submit a homeowner's claim. A homeowner's claim is going to apply to damage that occurs when you own the home and when your home insurance policy is in place. So when there's prior damage or things that maybe could have been filed on a home insurance policy from that previous owner, that doesn't roll over to you and become your claim on your new policy. So you want to buy that home when it's in good shape, it's been maintained, and of course is not a ticking time bomb. Derek, before we move on, give us a 30-second review of how an escrow account works in case we're not exactly familiar with what that means from an insurance standpoint.
Yeah, absolutely. An escrow account is a pretty straightforward piece of the insurance process, but it's very, very confusing when you look at a closing statement and the escrow requirements and the reconciliation and all this stuff that gets thrown into it. A lot of people are under the impression that the mortgage company actually insures their house. That's not the case. The mortgage company is simply paying the insurance company for the cost of your homeowner's policy, and they're taking a piece of every one of your monthly mortgage payments and putting it in a side pot to use to pay that policy each year when it renews. So the escrow account is really just your left pocket going to your right pocket and then going to the insurance company. So it's really just a vehicle to use to get those funds over to the insurance company to pay that homeowner's policy.
Got it. That's helpful. It's your money. It's just sitting in the escrow account and then being used to pay the home insurance premium.
That's exactly right. And I think one other thing to add to that is whenever there's a refund, instead of going back to the escrow account, which would be nice in some instances, it goes directly to the client, the homeowner's insured. So it's a little bit confusing when you get that refund directly from the insurance company instead of going into the escrow account, but we generally tell people to just take that refund, put it right back into the escrow account, as that escrow account is going to be paying future homeowners policies.
Got it. Perfect. 2 quick expert tips before we move on to teenage drivers. Expert tip number 1, like Derek said earlier, from an insurance standpoint, the insurance company is using the best of either spouse's credit score. You're probably aware that when you apply for a mortgage or any other loan, your credit score tends to drop because of all the inquiries on your credit report. So if you can qualify and you can put the mortgage in just one spouse's name, the other spouse is probably going to maintain a higher credit score, meaning that the insurance, for insurance purposes, will use that spouse's credit score, thereby qualifying for a better home insurance premium. Piece number 2, simply have your ducks in a row when you go into that process. Keep some cash on hand. All of us that have purchased a home know that there are unexpected expenses that come up. A home insurance policy is not a catch-all, do-all, fix every problem type of vehicle. So it's important to know that I've got to have something on hand, whether it's to cover my deductible or pay some of these things that a home insurance policy simply doesn't step in for. That's the home insurance side of things. Derek, the teenage drivers, part 2. Let's dive in.
Bring it on.
Obvious question, and certainly the most concerning question is, when does my teenager need to be added to my auto insurance policy? There's tons of good advice out there, but about 10 times as much bad advice out there. What is the answer to that question, and what do you hear?
Yeah, well, the answer is not what you see spattered all over the internet. I've heard many, many times that someone doesn't need to tell their insurance company about their new driver because the insurance company legally has to provide coverage for them. That's simply not the case. Someone needs to disclose the new driver in their household, usually when they've begun driver's training, when they've obtained their permit, or when they've got their full license and can drive by themselves without a parent. It depends on the specific insurance company. So our advice is always, when your child enters driver's training, disclose that to your insurance company, and then you'll know when they need to be officially added to the policy. It might be immediately, it might not be for 1.5 years until they have their fully designated license.
Got it. Okay. And what if I don't? You said that the insurance company doesn't have to provide coverage, so I need to report my driver. Is that right?
Yeah, that's right. So a lot of insurance companies these days have something called a duty to report changes clause in them. That clause says that if there is a material change to that policy that you did not inform your insurance company of, the insurance company can void the policy and deny a claim after 30 days. So if your teenager gets licensed and on day 31 they total your brand new car, the insurance company could deny that claim because you did not notify them of that new driver in your household within 30 days. An even worse scenario is if they caused an accident and God forbid someone was hurt or killed and you're looking at a big lawsuit. So keep in mind, you can't game the insurance system. There are provisions in your policy that say, if this type of thing happens, you need to make us aware, and the onus is on you.
Got it. Okay, that's helpful. Now, you've had clients, I'm sure, buying a vehicle for a new driver in their household, and we are not attorneys by any means, but we've consulted with a fair number to get their input about how should that new vehicle be titled. Should we title it just to the child? Should I title it to me as the parent? Should we both be on the title? Give us a 60-second summary of kind of generally what is the best route to take when it comes to the ownership and the titling of that new vehicle.
Yeah, we are certainly not attorneys. I can't imagine that either one of us have won an argument with our spouses anytime recently. But unfortunately, in this instance, again, it depends on the insurance company. In a perfect world, the parent would title the vehicle solely to the child. That way, if that child causes a car accident and God forbid someone is hurt or killed, the child's going to be named in the lawsuit, but the parent will hopefully be insulated from it because the child will be the vehicle owner as well as the driver. So if the insurance company allows it, some of them do, some of them don't, but it's best to title the child's vehicle solely to that child. That way, the parent's no longer the vehicle owner, ready to get dragged into a lawsuit due to an accident that the child caused.
Got it.
So something that a lot of people have some confusion about is just because the vehicle is titled to the child can still, in most cases, drive the other vehicles on the policy and have that coverage available to them. The titling thing is just for eligibility. Does this work? Is this something we can do? And again, that's something to ask the insurance company about. But in a perfect world, you would title the vehicle solely to the child.
Got it. That makes sense. So that I'm not on the title and I'm not also dragged into that lawsuit when something goes wrong. Now, what about maintaining a somewhat manageable insurance premium, Derek? Give us 60 seconds of how we can help prevent the insurance premium from exploding when a new driver is added to a policy. What are the big suggestions here?
Yeah, I think the biggest suggestion is the first line here. PLPD is a must. PLPD means that the teen still has coverage for lawsuits if they cause a car accident, medical coverage if they are hurt, those sorts of things, but there's no coverage for damage to the vehicle itself. So if the teen causes a car accident, maybe they scrape a parking structure, hit the side of the garage, do something like that, or maybe someone else that's parked in the high school parking lot, gives them a couple dings and dents. Well, the insurance policy is not going to respond to that because PLPD does not provide coverage for damage to the vehicle itself. That's the most affordable way to insure your teen driver. So make sure that the vehicle that they have has a value that you are comfortable not insuring damage to that vehicle. My suggestion is buy a newer vehicle, but just buy it with higher mileage. It's going to have modern safety features, but it's going to be a little bit less expensive because it's got 300,000 miles on it.
Got it.
Another thing is a lot of insurance companies offer a good student discount for teenagers that maintain a 3.0 GPA or higher. It's usually good for somewhere between $50 and $200 a year, which doesn't make their insurance free, but it certainly helps. The third line down here, don't put the child on their own policy. In 99.9% of instances, that is not going to be beneficial from a cost standpoint. If you really want to stick it to them because maybe you caught them sneaking out or something like that, that's a good way to do it because they're certainly going to notice their insurance premiums if you put them on their own policy. Lastly, there are some, second to last, there are some discount programs for monitoring your teen's driving. Pretty standard thing these days, but that's something to ask about as well. And now, lastly, keep a very, very tight watch on what type of claim you want to file for that teenager. The threshold for them has to be very, very high. The last thing you want is to have a 16, 17, or 18-year-old on your policy that now has an at-fault accident as well. You're going to feel like you added 2 teenagers to your policy if that's the case. So if you can pay for a claim out of pocket, it's painful to do that, I know, but in the long run, it's generally going to be best from a cost management standpoint to do that.
Got it. So talk to your insurance agent. They can give you some input about what is worth filing, what is worth sweeping under the rug. Couple of quick expert tips on the teenage drivers. Disclose your teen driver when required. Like Derek said, the best advice is as soon as your teen starts driver's training, notify your insurance agent. They can let you know when we need to make that change to your policy so that you've done your part and we're both headed in the right direction. Of course, a denied claim would be terrible for your teenager. It'd be terrible for you too, especially if you are potentially dragged into that lawsuit or it's your vehicle that was involved. Number 2, if buying a new vehicle for the family, make sure it's inexpensive. A few $1,000s. Safety, yes, we want it to be safe, but very important that it's something that you're okay with having PLPD coverage on it because that's going to help keep your auto insurance premium reasonable. With that, Derek, thanks for leading the charge here. We are to the end. We are 1 minute overboard, so we apologize for being 60 seconds overdue. But before we open up to Q&A, we want to thank everyone for joining us today. Thanks for working with us. Thanks for trusting us. Thanks for sharing in your insurance plan and all the opportunities to create a relationship